Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. Night Markets open at 6 to widen the conversation. Each week I'll be giving you my view on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. This week investor confidence dropped as worries about an economic slowdown started to grow. The S&P 500 index had its largest weekly fall in 18 months, with Nvidia leading the charge. It saw its market value shrink by about $300 billion during the week. This was due to rumors that the U.S. Justice Department might investigate the company for antitrust issues. Tech stocks led the decline in general, while the drop in the oil price also contributed to the particularly lackluster performance of energy shares. However, less cyclical sectors like utilities, consumer essentials, and real estate performed better. Some experts are also of the opinion that the declines were also linked to seasonal trends. September has historically been a tough month for stocks, with an average loss of 0.6% if you take data going back to 1950. Over the past 4 years, the S&P 500 has dropped 4.9%, 9.3%, 4.8% and 3.9% respectively in September. As traders returned from their summer vacations, we saw an increase in volume, which also increased the activity and volatility in the market. But before we get into markets and macro, let's just have a look at what the current situation is in the Middle East. In Gaza, health officials reported that Mohammed Morsi, a senior emergency services leader, and 4 of his family members were killed in an Israeli airstrike in the region. Israel now must continue to assign responsibility to one another for the mediator's failure to negotiate a ceasefire, which included the United States, Egypt, and Qatar. Despite the U.S. preparation of a new proposal, reaching an agreement seems unlikely due to major disagreements between the various parties. U.S. Secretary of State Antony Blinken emphasized that both Israel and Hamas need to settle remaining issues to achieve a sustainable ceasefire. And then starting off in the US, several economic reports this week showed signs of a possible slowdown in the world's largest economy. The Institute for Supply Management reported that US manufacturing activity stayed weak in August, with fewer new orders for the third month in a row. On the jobs front, the number of job openings in July fell to its lowest level since January 2021. Fewer people are leaving their jobs, which suggests that the labor market may be weakening. Meanwhile, a private report from ADP also showed that only 99,000 jobs were added in August. This was the smallest increase we've seen since early 2021. The official government report was also disappointing. Employers added 142,000 jobs in August, lower than the expected 160,000. Additionally, July's job growth was also revised down to 89,000, marking the weakest growth since December 2020. On the positive side, the unemployment rate dropped slightly, and wages also grew by only 0.4%, which was a little bit higher than expected. Despite these signs of a slowdown, investors still believe the Fed may cut interest rates soon, but the chance of a bigger cut, 50 basis point plus, have dropped a bit. Post the job reports release, US bond yields fell to their lowest level since May 2023. And looking at markets, the Dow Jones ended the week down by 2.28%, and the Nasdaq dropped by almost 5%, with Nvidia losing 13% in value during the week. Then moving across to the Eurozone, the UK, European Central Bank officials indicated this week that they will likely cut interest rates in September at their next meeting. However, they don't expect another rate cut in October. The goal of these cuts is to boost economic growth and tackle low inflation, which has been a persistent issue. In Germany specifically, manufacturing orders unexpectedly rose by 2.9% in July after adjusting for seasonal changes. However, demand for larger orders, especially transportation equipment, fell slightly. German industrial production dropped by 2.4%, a bigger fall than expected due to some problems in the car industry. As economic worries grew, stock markets in Europe also took a hit. Germany's DAX fell by 3.2%, while the CAC 40 in France dropped by 3.65%. And then moving further east to the Asia-Pacific region, in Japan, stock markets dropped sharply as the Nikkei 225 fell by 5.8%, and the broader Topix index was down by 4.2%. Semiconductor stocks were hit hard after the US-led sell-off, and Japan's export-focused companies also struggled because of the rising value of the yen, which makes Japanese products more expensive abroad. The yen also gained against the US dollar, going from 145 yen per US dollar at the end of the previous week to 142 yen per US dollar at the end of this week. This was mostly due to the fact that the market started pricing in the expectation for Japan to raise interest rates soon, while the US Federal Reserve is likely to cut rates in the US. Weak economic data from the US sparked worries about a possible recession, leading investors to seek safer assets. This increased demand for Japanese government bonds, pushing bond yields lower. Meanwhile, Japan's real wages, adjusted for inflation, grew for the second month in a row in July, thanks to pay raises and bonuses, but household spending barely grew. Moving further south to China, in China the stock market struggled as well. Weak earnings report and disappointing economic data led the Shanghai Composite Index to drop by 2.69%, while Hong Kong's Hang Seng Index fell by almost 3%. Chinese factories saw fewer new orders, with the official manufacturing PMI falling to 49.1. A reading below 50 indicates contraction, so this is clearly now in contractionary territory. The Chinese housing market also continued its decline. The value of new home sales from the top 100 developers dropped by 26.8% in August compared to a year ago. This ongoing slump has raised speculation that the Chinese government might introduce more measures to support the property market. And moving back home, locally, South Africa's economy grew by only 0.4% in the second quarter of 2024, really struggling to gain momentum. In the past year, the economy grew just 0.3%, which is far below the population growth rate of 1.5%. This means the economy isn't growing fast enough to improve living standards or create more jobs. Despite reading these as some positive signs, the fact that we did grow by 2 quarters in a row, South Africa still faces deep challenges. The slow economic growth shows that current reforms are not enough to tackle problems like high unemployment. And then looking at the markets, markets locally also followed their global counterparts lower, with the all-share index falling by nearly 3%. The resources sector, including mining, was hit hardest, dropping by more than 5%. But despite the global market uncertainty, the rand held steady at 17.85 against the US dollar. And then just looking at the week ahead, key this week will be the US inflation data that will be released on Wednesday. Both the CPI and PPI numbers will be scrutinized by the market intensely for possible clues to what the Fed's next move might be. The European Central Bank will also announce its rate decision on Thursday. The market will look forward to the first presidential debate between Vice President Kamala Harris and Donald Trump that also takes place on Tuesday. And then, as always, before we sign off, just an interesting investment idea that came up in discussions this week. We've received quite a few queries from clients on whether now might be the time to start looking at China, given that valuations are currently extremely low. China's property market, once the pillar of its economy, is now struggling and continues to do so. This is despite government efforts to stabilize the market, such as policy support and relaxed lending rules. The recovery, however, remains very weak. Developers seem to be saddled with debt, and consumer confidence in real estate is currently at historic lows as well. This slowdown doesn't only impact China, it's rippling across the entire Asia-Pacific region, where China plays a major role in regional trade. And why does this matter for the global economy? China's property market is tightly linked to sectors like construction, steel, as well as finance. With growth seeming to falter there, demand for goods from countries like South Korea and Australia is also starting to shrink. As China faces these hurdles, the rest of the region is also bracing for slower trade flows and economic drag. But for any economic revitalization strategy in Beijing to be effective, it's essential to incorporate 3 key components. we'll just need to see significant stimulus measures to increase demand, decisive programs to alleviate debt for local governments, as well as a new incentive system to motivate technocrats towards a pro-growth mindset. The final current risk to emphasize is that of the US election. We believe that regardless of the outcome, China faces the greatest risk amongst the various emerging market countries. The situation regarding China remains very dynamic, but given the size and influence of the Chinese economy, we believe that it remains something we cannot ignore. Hence, despite the fact that the current macro picture might not be conducive to an allocation, the fact that China's equity market is segregated into different listing locations, offshore versus onshore, and given the fact that the fundamentals remain solid, the way in which the allocation is implemented is key to how we gain exposure to the world's second largest economy. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m., night markets open at 6. To widen the conversation.